Let's just say that these next couple of days are going to be quite interesting, not only for the stock market, but also for the bond market with all these auctions going on right now. We're going to break down what my thoughts are, some articles, some basics here, and of course, we'll break down the stock market charts, all that good stuff. So if y'all find value, you know what to do. Hit that like button, make sure to subscribe. It's free, and you might as well follow me on X as well. Why not? Use that link down below, or just go on X, type in @StocksTalkStocks, you'll find me. And with that being said, guys, cheers. Let's dive right into the video. So I'm sure at this point you all know that there's been a lot of volatility, not only in the stock market, but also in the bond market. The 10-year treasury, wasn't it at over 5% recently? I think it hit 5.25 or something like that, and now it's back under 5%. I think it's at 4.7 or 4.6, maybe 4.75, something like that. Talk about volatility, right, guys? And there's a lot going on, which is what I want to break down in this video that probably will have a material impact on the stock market, right? Which is what this channel is, mostly focused on. Although today we're going to talk a little bit about the bond market as well, because these things go hand in hand, right? They go hand in hand. They're very important to understand. So let me show you guys what's been going on here with SPY, which you guys can see over the course of the last couple of months. It has been downtrending ever since August, right? And SPY is the S&P 500. For those of you guys that didn't know, it's the ETF that is most popular that people use that tracks the S&P 500, right? So this was at $460 back in the beginning of August, end of July, and now it's come down to about $440. It is down about 4% from that high, but at one point SPY was at, let's see, $410 per share, or about 11% off of the recent highs. In other words, it did get into a correction. It got into correction territory, right? And SPY, or Triple Q rather, which tracks the NASDAQ 100, this was at 387, and it got all the way down to about, let's see, $343 per share, or about 12% of a drop from recent highs. So that also got into correction territory. And since that point, same with SPY, it has rallied quite nicely over the course of the last couple of weeks, 2-3 weeks. You guys can see Triple Q has gone from 343 up to about 377, up 10% in just the past 2.5 weeks. And SPY in the same time period is up a lot as well. Let's see, from around 410 to about 440. That is over a 7% move, which is impressive. And during that same time period is where we've seen the 10-year go from, I think, 5.25 down to where it is right now. So that's, worked inversely, right? Let me actually pull the 10-year up so you guys can see the chart. So you guys can see right here, this is the US 10-year treasury yield. So it actually didn't get over 5%. So I was wrong about that a minute ago. It got to about almost 5% according here to CNBC, and it peaked at about 498. That was on the 19th of October. It hit 495 on the 25th of October, and that's exactly where the stock market started to reverse back to the upside. Literally on the 25th to the 26th, 7th of October, that's when SPY took off from 410. It started to take off from that point to where we are now, which is at $440 per share on SPY. Again, this works inversely. As you guys can see, this went from 498 in the middle end of October, and it dumped down to where it is now at 464, where, again, the stock market ended up going up during that time period. And we've seen a lot of volatility since August in the stock market and in the bond market. You guys can see here, the 10-year in August was at 419. You guys can see right here, 419. Let me zoom in and show you all so you can see it even better. 419 pretty much. It got down to about, let's see, 4.09% by the end of August, and then it ended up ripping all the way up to where it got to almost 5% from August all the way to about the middle end of October. That's when the stock market, if you guys saw, took a beating. SPY took a hit, same with Triple Q, right, as the 10-year ended up taking off. So now we have these auctions going on. So a bill auction is a public auction held weekly by the U.S. Treasury of the federal debt obligations, specifically T-bills whose maturities range from 1 month to 1 year. As of May 2021, there are 24 authorized primary dealers who are required to participate in the auction and bid directly upon each issue, right? So they're required to participate in the auction and bid directly upon each issue. A bill auction is the official manner in which all U.S. Treasury bills are issued. Keep that in mind. Very, very important that this is how they are issued. And I'm not going to get too deep into understanding a bill auction, all the nitty gritty. I don't think that's too relevant for this video, but you can see this on Investopedia for yourselves, guys. There's a lot of good info, of course, on Investopedia. It's a free source. No, they're not sponsoring this video, but it's just a great free source for anybody out there that wants to learn more about bonds, stocks, investing, personal finance in general. Investopedia, you really can't go wrong. You really cannot go wrong. So this is an article on MarketWatch. Let me show you guys this well-written article that I really enjoyed. You guys can see here, bonds' influence on stocks was on display once again this past week, which we just experienced this past week, right? On Thursday, a $24 billion auction of 30-year U.S. Treasury bonds showed some cracks in demand. Primary dealers were forced to accept 25% of the offering, more than double the average over the past year, and the auction had a large tail, meaning the Treasury needed to entice buyers with a premium yield over where 30-year bonds were trading in the open market. Pretty intense, guys. And the S&P 500, which had been rallying heading into that day, fell 0.8% that day, which was on Thursday. So you guys have to realize this is huge right now for the stock market in terms of the auctions, the bond market, how yields are looking. I mean, you guys saw the 10-year, it's moving inverse to the S&P 500. You guys have to realize that right now. And you can see right here, it's a potential preview of what's to come. The federal government ran a deficit of $1.7 trillion in its fiscal 2023, which ended in September, more than its entire debt load in 1985, which is nuts. That was 40 years ago, right, guys? Or 30 years? Or, yeah, 40 years ago. Geez, I'm losing track of time here, guys. What's going on? And heavy borrowing means lots of Treasury issuance, which, of course, you guys know how much in debt the United States government is, right? Just as the two biggest buyers of the past decade are largely out of the market, the Fed is doing quantitative tightening, and China has other issues, which we won't talk about China in this video. And it turns out demand for Treasuries is not limitless. It's not limitless demand, guys. And look at this. A failed Treasury auction, quote, this is from, I think, who quoted this? Tim Horan, which is a chief investment. He's a chief investment officer at Chilton Trust. He said, quote, a failed Treasury auction is what really keeps me up, which I guess this guy's not getting any sleep, right? He's going to need more coffee out there. Cheers, by the way, guys. So that's what keeps him up. And he said, quote, it would certainly be a Minsky moment, using a term that refers to a market collapse brought on by the sudden unwinding of excessive debt, which is a lot of people's fears out there, and a lot of the perma bears, not calling this guy a perma bear, but a lot of these bears out there, they've been calling for this for quite some time. You guys probably know if you've been listening to the different voices out there, right? The influence of the fiscal side of the yield equation will only get stronger. The U.S. federal deficit will be in focus this coming week, with Congress facing a deadline on Friday to avoid a government shutdown. Even the most Pollyanna-ish amongst us does not expect Congress, with a newbie Speaker of the House, to suddenly rediscover fiscal probity and balance the budget by the end of this week. Obviously, that's not going to happen, guys. A government shutdown is a more likely outcome, or a continuing resolution that keeps the current excess of spending over revenue going. A return to a 5% yield on the 10-year isn't out of the question, which you guys saw the chart. We were just at 5% recently. Now we're at 4.64. we could probably get back up there, which would not be good for the stock market in the short term. And in the near term, the risk is that yields go higher, says Adam Abbas, who's the co-head of fixed income at Harris Associates. He said, quote, "There's a lot of treasury supply out there and the deficit narrative is gaining traction. There doesn't seem to be a long-term solution in Washington." And honestly, guys, when is there ever a long-term solution in Washington? All they care about, let's be friggin' honest here, is the next year, next 4 years, re-election. That's it. They don't care about the actual future of America. Maybe some of them do. I don't know. Some people in the government. But a lot of them just care about them fattening their pockets while they're in Congress or while they're in the government. The next 4 years, the next 2 years for re-election, it's a BS game. All they do is kick the can down the road. You guys have heard that, kick the can down the road, and that's what's gotten us to a point where we're in this much debt. We're facing this inflation that we're facing right now, and it's just, it's because of the generations in the past that have just not given a crap about, they cared about their pockets, fattening their pockets, right? But they have not cared about the longevity of America, the economy, at least in my opinion. What do you guys think? Let me know your thoughts down below in the comments, but that's kind of what's going on right now. We have this bond auction going on, and there's a lot of people, a lot of these high up people are nervous about the demand for these treasuries and the risk of the 10-year flying through the roof again. That's a possibility at this point. I don't know. I'm not an expert in bonds, obviously, guys. I'm more of a stock market guy, but these things, like I said, go hand in hand. And this is an article from CNBC that was written about 2 weeks ago, so I'm not sure how relevant it is still. But you guys can see the Treasury will auction $112 billion in debt next week, which 2 weeks ago, I guess that was last week, right? So $112 billion in debt next week to refund $102 billion of notes set to mature November 15th, raising more than $9 billion in extra funds. 112 minus 102 gives you that $9 billion of extra funds, and the sale will come in 3 parts starting on Tuesday, with $48 billion in 3-year notes, with the subsequent days featuring respective sales of $40 billion in 10-year notes, then $24 billion in 30-year bonds. And again, this is not really relevant anymore because it happened about a week ago, but still, you guys can see, yeah, there's a lot of notes that are going on the auction, right, guys? And who knows how this is going to play out moving forward. Of course, we'll break down more on this channel. We'll break down what's going on, how it's affecting the stock market. So make sure you guys subscribe, hit that like button, follow me on X as well at Stocks Talk Stocks. You might as well do that. And guys, don't forget to get your free stocks from Moomoo. Use that link down below or go to stocksurfest.com/Moomoo. Once you open up your account and fund it with your initial $100 deposit, you get 5 stocks, each up to $2,000, and you get a free share of SoFi stock as well, totaling 6 stocks, again, with just a $100 deposit. And if you fund your account at least $1,000 on top of those 6 stocks, you get 10 more stocks, totaling 16 stocks. So get on it, guys. Use that link down below. And with that being said, cheers. I'll catch you all later.